Hello and welcome to this channel. My name is Victoria and I really like experimenting with cryptocurrency trading. For me, it's more like a game, a puzzle, or a problem to solve. And in this channel, I would like to share what I learned, my insights, and results of my experiments as well. But this is only my personal experience, so a quick heads up, trading is a very risky area. Please be careful, only invest what you can afford to lose. And I'm passionate about different challenges and experiments, and this recording is also a kind of experiment for me. I've never done this before, so I will start with just a simple basic problem that many cryptocurrency traders face. It's when you need a specific asset that you don't have, but you need it for trading or other purposes, and you don't want just to sell your coins in exchange to this asset and be vulnerable to its price volatility. It's a very tricky situation, right? I will give you an example. Let's say you have BTC, but you need USDT for a trade. And you sell your BTC when the price is around 50,000 USDT, and you trade with those USDT and even earn some profit. But in the meantime, BTC price skyrockets, and when it's time to convert back to BTC, you end up only with half of your initial investment. It's a very frustrating situation, right? So I would like to share my approach to this problem, and I will focus on two basic techniques, borrowing or lending, and hedging on perpetual or any other derivative markets. So if you're ready, let's get started. And let's begin by exploring the borrowing method, which is actually quite simple. Suppose you have BTC but need USDT, as in our previous example. But instead of selling your Bitcoin, you simply deposit it on a lending platform, which could be a cryptocurrency exchange or a decentralized finance platform. And in return, you receive USDT. After completing your trade, you repay the USDT along with any interest and then retrieve your BTC. In this scenario, your BTC acts as collateral or security, assuring the platform that it holds the full amount of USDT. And you need a higher collateral value than the loan amount. So in simple words, you need to deposit more value than you receive. And this is necessary to serve as a safeguard against price fluctuation of your collateral. So the platform has no risk of holding less amount that it has given you. So if your collateral value decreases, like when the BTC price goes down in this example, your loan could be liquidated, and this allows the platform to return the amount it has lent to you. To better illustrate this, let's revisit our example, focusing on the loan-to-value LTV ratio. It's a crucial measure in borrowing. This measure compares your loan value to your collateral value expressed as percentage. For example, suppose you own one BTC currently priced at 50,000 USDT and you borrow 25,000 against it. Your LTV value in this case would be 50%, so 25,000 divided by 50,000. Raising this loan to 35,000 USDT increases the LTV to 70%. And borrowing 50,000 USDT for your one BTC would make the LTV equal to 100. However, you can't borrow the full amount. As mentioned earlier, your loan amount should be less than the collateral amount, and different platforms set their own maximum LTV limits for borrowing. If it's 70%, as in this example in the middle, it means the platform restricts you to borrowing a maximum of 35,000 USDT against your one BTC. And the LTV is dynamic, changing with the market price of your collateral. For instance, you have a loan of 35,000 USDT with an initial LTV of 70%, and the price of your collateral of BTC rises to 70,000 USDT. In this case, your LTV decreases to 50%, calculated as 35,000 divided by 70,000, and this scenario is beneficial as the price can increase indefinitely while your loan remains safe. Conversely, if the price falls, say to 40,000, your LTV would increase to 87.5%, potentially risking loan liquidation. And liquidation rules vary across platforms. For example, if the liquidation threshold is 90%, your loan could be liquidated if the price drops just below 39,000 USDT. And the platform does this, as I said, to ensure it recovers the 35,000 USDT that it gave to you. So if your LTV rises, so you'll need either to repay some of the loan or add more collateral. So that's it. Now let's take a closer look at how this works on real platforms. Here I have two platforms, Binance and Gate.io. And to visit loans on Binance, go to More Loans, and on Gate, go to Finance Crypto Loan. And first, what you can see here is the coin that you can borrow and borrowing rate. And they have hourly and annualized interest rate. For example, the USDT current annualized rate is 35%, but this rate isn't fixed. It will change over time with market conditions. You can fix it for 7 or 30 days, but the current stable rates aren't very attractive on Binance. And you see the same as on Gate. They have different coins and different rates, and the current rate, flexible rate for USDT for borrowing is much lower than on Binance. It's 16.6%, while on Binance it's twice higher. And if you click on borrow button, you will see like a very simple interface and all the requirements and conditions. And for example, we want to borrow USDT, and as a collateral, I will choose BTC, and I'll enter the maximum 1 BTC here. And you will see here that you can borrow 54,000 USDT for your 1 BTC, while the current price is around 70,000 USDT. And that's because the initial LTV is 78% on Binance. So if you divide this value, 54,000, by this value, 69, you will get this 78% LTV. The same is on Gate.io. If you click on borrow button, you will see here the coin that you want to borrow and the collateral. And Gate.io offers multi-collateral, so you can use multiple coins as your collateral or single. I will choose single for simplicity and also enter 1. And here you can see that the maximum amount that you can borrow on Gate is lower. But that's because the current LTV, the maximum LTV on Gate.io is 70%, while on Binance is 78%. The next thing that you should consider also the liquidation rules. The liquidation LTV on Binance is 91%, while on Gate.io is 90%, and these values are very similar. But if you look into liquidation price, on Gate.io is 54,000 USDT, while on Binance is 59. And this liquidation price on Binance is higher just because you're borrowing the higher amount here. So you see it's very simple interface, and after you click confirm, you will get to USDT and they will be in your wallet and you can trade or use it as you wish. And I can show you how your open loan will look like. I have one loan here opened. So I'm borrowing USDT and I have multiple collateral here. And you see here the current LTV, it will change when the price of BTC and Ether will change. And I have some unpaid interest here. So if I want to repay my loan, I will need to repay the full amount of USDT plus in interest, like $66. So that's all. And you see the borrow method is the most easiest one. So let's explore the next one. Now that you are familiar with the borrow method, let's move on to the hedging technique. The fundamental principle of hedging involves executing two opposite trades on different markets, such as spot and derivatives markets like Perpetual. And you maintain the position on Perpetual open as long as you require this specific token. For example, in our initial scenario, if you need USDT but have BTC, you would sell your BTC on the spot market to acquire USDT, and simultaneously you would enter the opposite position alone or buy in derivatives. And the key element of this approach is using leverage, which allows you to open this hedging position with a smaller amount of capital. And this required capital is known as the margin, and the amount of margin required depends on your risk tolerance. So larger margin generally implies lower risk. So what's next? When you decide to retrieve your BTC, you simply need to close your position on Perpetual and buy back the same amount on the spot market. Now let's see an example of how the value of your BTC remains constant in different market situations. Suppose you have one BTC which you sell for 50,000 USDT, and simultaneously you open a long position of one BTC on Perpetual using 15,000 USDT as your margin. This leaves you with 35,000 USDT free for trading or other purposes. And let's imagine the price increases to 70,000 USDT. This means your long position is in profit with a gain of 20,000 USDT, and you still have assets worth of 50,000 USDT. So in total, you have 70,000 USDT, equivalent to the value of one BTC. Conversely, if the price drops to 40,000 USDT, your position have a loss of 10,000 USDT, but you still have assets worth 50,000 USDT. Therefore, you hold 40,000 USDT, which is also equivalent to one BTC. In the scenario where the price rises, your position is profitable, and when the price falls, your position suffers a loss and could face liquidation. And the liquidation price depends on your margin. Here you have a margin of 50,000 USDT, so your loss cannot exceed this amount, often even less, as exchanges usually set certain limits. So if the price moves against your position, you need to either close it and retrieve your BTC or add more funds to your margin. Now let's also consider the fees involved in this process. It's essential to remember that you must pay fees for opening and closing your orders. But unlike the interest rates in borrowing, the perpetual market has a funding rate, and I will just cover in short what it is. The funding rate is a mechanism that helps align the prices on perpetual and spot markets. It consists of periodic payments between buyers and sellers, typically every 8 hours on centralized exchanges or 1 hour on decentralized exchanges. So in scenario when the price on the perpetual market is higher than on the spot market, the funding rate is positive. And in such case, buyers, those who are in long position, pay sellers, those who are in short position. This typically occurs in a rising market, making it easier to remember. So in a bull market, the funding rate is positive, and those in profit from long position compensate those who incur losses from this upward movement. Conversely, when the perpetual price is lower than the spot price, the funding rate is negative. So here, those in short positions pay those who are in long position. This usually happens in a bear market where the market price is falling. However, it's important not to view this as a disadvantage because it all depends on the direction of your trade. For example, if you are shorting and the funding rate is positive, you could actually profit from your hedging position. So instead of paying a rate like the interest in borrowing, you might earn some profit, which can be like a significant advantage for you. So now let's move also to the real example and see how we can open these trades in real platforms. I have here Binance, and I opened two windows, one is spot and one is perpetual, and I made them different colors just to distinguish one from another. Perpetual futures is black and spot is white. And suppose I already have USDT for simplicity, and I need to get a coin like Matic. So first what I would do here, and I would understand how much of my USDT I would like to put into my margin into futures account. And here I would like to go with 20%, $20. So first I will transfer $20 here to my futures account. Next, I will go on spot and understand how much Matic I can get for the rest of my USDT. And the price here is almost $1, so it shows me that I can acquire actually 80 Matic. And if I put 80 Matic here as well, it shows me that with my 4x leverage, it needs like almost 20 USDT that I have here on my account. So next, I will just open market orders, not limit. Of course, you can go with limit, like to open a limit order on spot, for example. And when it's filled, you can go with market orders, with market order on perpetual. And it all depends on the spread and the fees, where is less fees, either it's on perpetual or on spot. But here, just for simplicity, I'm going with market orders. So I'm making sure that I'm actually getting 80 Matic and I'm on market, and I will click this by Matic, but I will not just set everything ready. And here I will also go with market orders, and I will put 80 Matic here, and I will go with short here. And I really advise you to go first with the small amount of your entire order, just to be sure that everything goes smoothly. And if you need to get like a huge amount of your coin, of this coin, also go with like multiple iterations, so you not have a lot of loss on the price change. And so here I have just one $80 deal, so I will go in one iteration. So everything is ready, so I will go with short here, and I will buy here. And I'm making this in like different windows, but usually I'll do this in side by side windows, or using my phone app and my laptop. But here also, for simplicity, I'm showing it like that. So I have actually 80 Medic bought, and here I have my position opened. So what's next? Next, you can see here your liquidation price, and it's around 24% from the current price. So track this price. If you are near to be liquidated, add more to your margin, or just close your position. And what else? You also can find here funding rate, and currently it's positive and you are shorting, so you will get profit out of this position. And so you have your Matic, you can then trade it, and when you need back your USDT, you just close this position, and at the same time you sell the Matic here on spot. So that's it. You see, it's not very difficult to do. You just open opposite trades and make sure that everything goes smoothly, starting with small amounts. And when you are ready, you just close your position and open the opposite trade on the spot, and you have back your assets. Like here, you have back your USDT. But of course, you paid some fees, so you have a bit less. But if you have funding rate go into your direction of your position, you probably will be in profit. So that's it. I really hope you enjoyed watching this, and I encourage you to try both methods and learn by doing, not just by watching. This approach lets you add new tools to your toolkit, and it also helps you connect these new tools with what you know now and what you'll learn in the future, and generate new ideas. And to be honest, I only started trying borrowing this year. Before that, I was a bit skeptical, and I remember thinking that I didn't need this tool because of the interest rates and the need to lock up my assets. But now I use it daily, and I see how my mind constantly finds new ways and ideas to use it. So just try and understand it, even explore how liquidation works, and have fun while doing this. It's much better to experiment with smaller amounts of money in a controlled environment rather than facing liquidation with larger amounts. And I also encourage you to try different variations. These are just the basic methods, but there are many more variations of these techniques. Just to name a few, instead of using perpetual contracts, you might try delivery futures or margin spot trading. You could also explore decentralized exchanges, or in terms of lending, decentralized finance platforms like Aave. So my main idea is to play, have fun, enjoy the process, and after all, have profits and be happy.